there, it's me, Stephen Thomas, with another housing debrief. Thank you so much for joining us. Now, as far as real estate's concerned, what drives real estate more than anything else right now are mortgage rates. We've talked a lot about mortgage rates. Within the last 10 days, there have not been that many data releases. So economic data releases really move the interest rates either up or down. And in the last 10 days, not a ton of data releases until today. This is being, we're recording it on May 30th, and that's when GDP came out a little bit lower than what expectations were, so it came down a little bit more. And so that was a report that came out today. And then tomorrow, May 31st, last day of May, we get PCE. Now, that's personal consumption expenditures. It's similar to CPI. It's an inflation read, just a basket of goods that everything that we consume, and it's just measuring how much they're either going up or down. And of course, we've had a lot of inflation recently. Now, PCE is a better indicator of inflation than CPI, and it's the preferred inflation indicator by the Federal Reserve. So everybody is going to be watching tomorrow's release very closely, because that should move interest rates based upon whether it exceeds expectations or is below expectations. If it's below expectations, we can watch interest rates float down. If it's above expectations, why the reverse happens, and we have higher rates. But this week, we're getting into housing is slowing. And so wanted to talk about this trend that has developed this year. And it has a lot to do with what we talked about in last week's episode, and that's with supply and demand. You have to understand, we're dealing with a limited supply, but this year, supply is actually growing, and there are more homeowners coming on the market. So there are more for sale signs that are accumulating because we have the almost identical demand that's pending sales activity as we did last year. So if there are more homes coming on the market and pending activity is very much the same, the market is slowing down. Now, if I told people that this was what the underlying trends were back in February and March, and it was like, but Steve, it's so busy. But we're watching the underlying trends, and slowly but surely, as the market slows, we're watching that the time on market increases. And as that happens with more and more homes, we're witnessing more and more homes that have been on the market for longer than expectations. Now, I developed this particular topic because I was speaking in San Diego at an office, and that office, they were talking about the different listings they had and also the buyers they're dealing with. And it was interesting to hear them talk about with the listings that it was after the initial week, things weren't selling really quick, and and these homes could be on the market for a couple of weeks. Then all of a sudden they received an offer, and then the very next day a second offer, then a third offer. Whereas when the market was hotter, they had the home exposed the market for a weekend, and by the time we got to the following, the beginning of the week, they had already generated several offers. So that is a bit of a change in the marketplace that has materialized over time, and that is just by more homeowners coming on the market and now are competing against each other. And that goes. It's coming at a time when interest rates have been stubbornly higher than last year. So last week we talked about the United States inventory, and if you see the United States inventory, we're very, very low level. We're at 1,210,000, and this actually has gone up from the very beginning of the year, and you could see that small little climb on the right-hand side. Each one of those Himalayas is a year, but it has been rising. But it's very low compared to where we were back in the past. So for all of those people that are talking about crashes in the marketplace, you actually need way more inventory for that to occur. And we're not even close to that occurring pretty much anywhere across the United States, because this doesn't rival 2006, 2007, 2008. Some markets, a few, like Texas and Florida, are back to prior, and Boise also, prior to COVID levels, but across the United States still has not made its way back to where we were prior to COVID. And so what we're actually going to talk about this time was, last week we talked about inventory. This week it's the United States monthly supply. And I'm pointing over here, the monthly supply on the right-hand side. It's relatively low. It's below 4 months. And I'm going to zoom in and show you that's this year. So there has been a rise from the very beginning of the year to where it is right now. And it is rising. So there is that's overall slowdown. And this is actually a reflection more of like March versus where we are today. This is kind of an absorption rate of supply. So it's not the same indicator that we use that reports on housing. This is market. This is the months of supply that National Association of Realtors comes out with. And for them, what they've always talked about is at 6 months, that mark is where it moves from a seller's to a buyer's market. Now, I really don't, it's not like a light switch where all of a sudden when it gets above 6 months, it's all of a sudden a buyer's market. There are different stages of the market, and that's how we judge expected market time, our statistic that reports on housing. But let's talk about that months of supply. This is the 6 month mark. And if you look, the last time it was well above that 6 month mark was when? We're looking at the left-hand side of this chart. That is the 1990s. That is the savings and loan scandal, which was caused by the real estate industry and loans. And there was a fraudulent lending going on. And as a result, there was a significant downturn with foreclosures and short sales and banks that went out of business, savings and loans that went out of business. In the middle part, that's the Great Recession. That too was caused by the real estate industry. So since then, we've actually had everybody has been qualifying for their homes. We don't have subprime. We don't have all the negative stuff that's out there. So way different marketplace with very, very limited inventory. The only big negative against the housing market right now are those higher mortgage rates. So, and I'm pointing to both that savings loan and the Great Recession. Now, when you have these high mortgage rates that I just talked about, what that is doing ultimately is it's squeezing when the housing market becomes a buyer's market, and it comes in stages. It's not all of a sudden it's sellers to buyers. Like I said, it goes actually from sellers to what we refer to as equilibrium, which is a balanced market. Doesn't favor buyers or sellers in negotiations. And then the higher the months of supply, the more it becomes a buyer's market. That's when it's above 6 months. Now here, but because of these higher rates, it actually has squeezed it, and so it's gone from 6 months down to under 4 months is what we're looking at when I look at this months of supply by the National Association of Realtors. Now in 2022, this actually was below this line that I'm referring to. But the reason we had values go down for 6 months across the United States was because we were psychologically, as a marketplace, buyers and everybody else, and everybody across the United States absorbing this skyrocketing mortgage rate environment, going from 3.25% at the start of the year, all the way to up above 7%, 7.37% by October of 2022. So this was even below that orange threshold, yet we had prices come down because psychologically there was a lot of buyers that absolutely, they were skittish about purchasing. They didn't want to pay as much as some people did when they were paying 10s, 20s, $30,000, 40, 50, even in some marketplaces over $100,000 above the asking price. They would take a look at all the comparable sales. They'd see that one that was sold for a lot more than the most recent sale prior to that, and they said, we're not going to pay that. So we kind of got a deterioration in pricing as the market started to absorb these higher rates. But now that we've had these higher rates for longer, we've kind of seen it with this low inventory that it takes a little bit more inventory to see an erosion in pricing, and we're not really there. There are some markets that are across the United States, but by and large, it's still not a buyer's market. It's still a seller's market. It's just not as hot as where we were last year, because there's this real interest rate sensitivity to our marketplace. Anything above 7% really slows our marketplace. Anything in the sixes, and the lower you get in the sixes, the more that we actually see a better churn in the marketplace. We see more demand, more pending sales, more buyers come into the marketplace. Even more homeowners will place their homes on the market, but demand increases way at a stronger pace than the number of homes that come on the market. So it will actually deplete the inventory, and we'll actually watch the supply go down when rates go down in the future. people want me to give them a time frame for that. We just can't do that. I will not put a time frame on exactly when that's going to happen because we don't know what the data points are going to look like going forward. Nobody does. And you can actually see these are where interest rates are as of today. They actually ballooned up. They were at 6.99% in the middle of May, and then since have ridden up a little bit with not a lot of data. Some of this just had to do with speculation, end of month selling, and there's just a number of reasons that it actually was floating higher. And they were people with not a lot of data. They were reading into Fed minutes that were released, and they were trying to read between the lines because there was just this vacuum of no real good economic data points for them to cling to. So that's why we haven't had that much of a drop. Today we got a little bit of a drop, and that was because of GDP. And I'll show you this is from January to I don't know why we say May 4th, but January to May of 2024. You could see here that we've been stuck above 7%. This is from the start of the year to where we are today. It's been stuck above 7% for more than half of the year. And really, since April, other than those couple days that I just talked about in May that were 6.99 earlier this month, that were at 6.99 for a couple of days, since then, it's just remained above 7%. So that's that psychological threshold where it kind of slows the market and allows, as more homes were coming on the market, we had very, very similar demand as to last year, and we were accumulating more homes. If you accumulate more homes, it slows the market if you're dealing with the same exact demand as last year when fewer homes were coming on the market. Because you can compare this to last year. This is January to May of 2023, and you could see that's the 7%, that same 7% line. For the most part, it was below 7%. It was in the sixes. So it was allowing the market to actually churn a little bit more. There weren't as many homes coming on the market back then. But if there were more homes coming on the market back then, we actually would have seen more pending sales. But that's because the rates were below 7% threshold. Later on in the year of 2023, of course, interest rates made their way all the way up to 8%. It remained above 7% from the end of July all the way to the second week of December. So later on, they had that big patch last year of the marketplace above 7% threshold. But for the first half, it was met with lower rates, second half higher. The overall census is that the first half of this year, we're going to realize higher rates, the second half, lower rates. So this affects the speed of the market when we have interest rates that are stuck above 7% for quite some time since April. So that's kind of a long time with duration above 7%. So we're having that same issue of a couple months so far, and it's really slowly but surely been slowing down the overall marketplace. And I'll show you what that squeeze looks like just by utilizing Southern California because we have data that goes back further. Started this all off with Orange County. We have data that goes all the way back to 2004, but this kind of helps you illustrate what's really going on. And this is where we were prior to COVID with interest rates where they were at normal levels. Above 150, it was considered a deep buyer's market where values were really going down. From 120 to 150, this is our expected market time statistic. That is, you place your home on the market, when are you going to become a pending sale? And it's based upon not closed sales, like a lot of the metrics when they're talking about how many months of inventory there are. This is based upon current supply and the current velocity of pending sales. And we do our math and we come out with the expected market time when we looked at the same statistic over time. And this is where we determined that above 150 is deep buyers. It's a slight buyer's market, which means values aren't really coming down that much. They're coming down a bit. And it's between 120 and 150. It's balanced equilibrium between 90 and 120. And between 60 and 90, it's a slight seller's market. Values going up only slightly. And we have, sellers are more in control of the negotiating process. Now, below 60 is considered a hot seller's market. And where we were during the COVID years of the second half of 2020 through the first half of 2022 was below 40 days. And you can actually see that in this chart. In a lot of markets across the United States, we're below 40 days. That's where it got really, really low. And we had the velocity of appreciation was just out of this roof. It was values were skyrocketing higher at an unprecedented rate, and that is because of how fast the market was moving, something that we had not really seen other than a few weeks in 2013. And but what happened with higher rates, now that's with normal rates, not prior to the pandemic. Because prior to the pandemic is actually prior to all the way up to 2022 when rates really skyrocketed. And you can see what's happened is we've gone from 150 days being a buyer's market and a deep buyer's market, and a below 60 days to be a hot seller's market. And what's happened with higher rates is it's squeezed all the price ranges. And we have now below 40 is a hot seller's market, between 40 and 60 is slight, and between 60 and 80 is a balanced market. Between 90 and 100 is a slight buyer's market, and above 100 is a deep buyer's market where values are coming down. Now, you can actually see, we actually have not really hit it. We hit it for a minute. It was like about 45 days, and that Himalaya at in the middle of the year was actually, we saw these market times spike in all markets, and that was when interest rates in 2018 had grown all the way up to 5%, and people were freaking out with 5% interest rates. And boy, looking back, 5% isn't that bad compared to where rates are at today, stubbornly high. And these are the different market times. If you compare them to last year to this year, Bay Area is at 62 this year versus last year at 46 days. And Vegas is at 57 versus 50 days last year. And Phoenix at 70 days last year, 43 days this year. And SoCal, 68 days this year, 48 days last year. So you see, all markets are experiencing a slower market. Now, it's not quite a buyer's market, but it's not a hot seller's market either, where it's below 40. It's more of either a light seller's market or moving its way towards balanced. And that's where you have to be a little bit more careful on how you're pricing, because there's now, with these higher rates and more homes that are competing against each other, what we're seeing in many, many markets is actually pressure on pricing. So we can no longer see that values are rising. And that's kind of what the data is telling us right now. So if you're a seller, a lot of sellers out there right now are just scratching their heads going, what in the world is going on with the marketplace right now? And quite simply, it has to do with those higher rates and more competition, and something that we've seen evolving over time. Now, I do not want buyers to get ahead of themselves and think this is a cause for celebration. We're about to tip into a buyer's market, because we've talked about it before. We are really close to mortgage rates coming down. So as soon as that happens, we're going to see an increase in demand. So, and when we see an increase in demand, we'll see demand going up and supply actually coming down. And with the combination of those two factors happening, we watch our expected market time drop. So the markets will get hotter when that happens. So if you're a buyer, this is a really good time right now to be jumping in. So, and if you're a seller, don't get ahead of yourselves either and think this is the end of the world. You know what? Go to your calm place and sharpen your pencil. And at the end of the day, scrutinize all of the comps. Go through all of the comparable sales and pending sales and be very, very meticulous and careful on arriving at the price. And do not be greedy. It really comes down to, you really have to come out of the box at the right price. That's where you're going to get the most fanfare. That is where you're going to get your the most bang for your buck, is if you come out at the right price and get that activity at the very, very beginning, because that's when you want to get that offer, rather than reducing the asking price down the road. We've done reports in the past that show when you have to reduce the asking price by a certain percentage, that you actually end up netting less. So if you like this content, please like and subscribe our channel. Go to reportsonhousing.com to subscribe. There's a lot of content there. There's free content there. There's all of our videos are housed there as well. And the most recent one that just came out, and it's the markets along the coast, and then the Bay Area and Clark and Maricopa and the Inland Empire will get this next week. It's called Busting Myths. And there's a lot of myths and junk circulating around there from all the false narratives that are out there, especially on YouTube, TikTok, and Instagram. So if you'd like to get a free month, and you go to reportsonhousing.com to subscribe, enter the coupon code BUYER for a free month, because right now buyers are getting a little bit more juice. They're able to deal with fewer buyers that are competing against houses. There are more homes that are out there to take a look at. So this is starting to work out in their favor in negotiations. It's still a seller's market in many, many markets, but you just have to be careful on price. And if homes are priced appropriately, expect a lot of attention and, of course, multiple offers as well. So I thank you again for tuning in to another housing debrief. I hope you enjoyed this. If you have any questions or you'd like to see future topics down the road, put them in the comments section. Please like and subscribe, and have a fantastic finish to your week. We will see you